Okay, hello everybody. This is Omar Ruiz and Mike Morowski, and we're excited here to be with you all here on this webinar to talk about the last quarter, one more quarter left here before we can maximize 2025 and how a pending decision here for you this summer could build 5 years of passive returns. We're going to be talking about some market dynamics out there that make multifamily a very favorable investment option for you, and to also go into a specific deal that we have going on right now that's going to produce those 5 years of passive returns for you. Great to be with you here, Mike. How you doing?
I'm good, Omar. How are you? Good to see you again.
Yeah, I'm doing great. And for those people that are just joining with us, we do have the chat room is open there. So if you have any questions, we may have time. We have some limited time on this webinar, may have time to address those. And if not, we can definitely email any responses back to you. And let's go ahead and get into it. So first going through some market dynamics and what's happening right now as far as ownership and renting. And this is one of the reasons why rents are going up, and because the cost of home ownership is going up to historical highs now. The average single family home now costs 90%, 97% more per month than the average rental on an apartment. And so for guys like us, me and Mike, that we are owners of rental properties, apartments, and multifamily, this is a good sign for us because it means that people are going to be renting for longer periods of time. And you can see the historical average has been 35%. We are way, way above that. And this has largely to do with the lack of construction that has happened out there with single family homes. And as that continues on, it's just going to make these numbers, it's going to make it more difficult for people to own their own homes. Um, so this is a very important slide here that is a boom for multifamily properties. This is another very important slide. This has to do with construction starts. Now, there's been news about how rents out there have been kind of, they haven't been going up as much as they have historically since pretty much since COVID. So COVID boosted but a lot of kind of artificial demand out there. It kind of pulled demand forward into the future, into the present. And so because of that, it got developers extremely excited. And so they just started applying for new plans, developing a lot of extra supply that that didn't really have really honest demand for. Because like I said, that COVID demand pulled demand forward in the future into the present. And so you see here, in 2021 and especially in 2022, it just peaked. The construction starts out there. And so now what's happening now, especially since 2022, when the interest rates really started going extremely high, it made construction so much more expensive and difficult to develop new construction that all the developers just stopped building out there. It just didn't, the numbers just didn't pencil out for them. So now here, and you can see here already in 2024, it already went down to the historical average here. Now, this does not have 2025 numbers, but I could tell you there's a lot of construction that's just not happening right now. Building permits have been going down. And so because of that, that's going to normalize the rents out there. And you're going to see rent growth start happening here. It's already happening in 2025. Just the numbers haven't popped out to advertise out there. But this is you can see the obvious cycle going on here. You have these peaks, these valleys, these peaks and these valleys, and now it's coming back down. So this is a very important slide because this boost in construction is what caused softness in the rents in the last, especially in the last year in 2024, and now it's getting back to normal here. Now, this graph here, this image here, talks about the market cycles and the different quadrants here. And basically, when you start out here in phase one, this is the recovery phase here. And you really saw this phase happen there in back in the Great Recession, the period between 2008 to 2010, really 11 and 12, when it started kind of coming back up. And that's what this is illustrating here. The phase of recovery coming up slowly here. And then when you get this expansion phase, you have declining vacancies and a lot new construction. And this is where the developers start coming out, start getting excited because these vacancy numbers are going down. And for them, this is a signal for them to start building. And you can see here, just like we have our cycle going on over here, go to the previous slide, you got the same thing going on over here. And this is almost kind of like a mini cycle here, but you can equate this to kind of this period in time. And that and then you have your peak, and that creates this hyper supply. This is your phase three. This is now where vacancies are increasing, but along with those vacancies increasing, you also have rents decreasing as well, getting soft, and now the no really new construction is just kind of getting phased out. And that's what we're getting into right now. We're going into the recovery phase of this, where this is going to start bottoming out. We had our recovery in here, which is right here. You see here 2024 going into 2025. And now, as we're getting into the recovery phase of it, really a recession, so to say, not a recession like in 2008, but more like a correction now that's going to be happening here. This is the time to take charge of opportunities uh, and invest out there in properties that are cash flowing. And we're going to be getting into that here on a particular opportunity that we have here coming up. Um, and this is another interesting slide that also helps out with multifamily. You have younger people in the 30s here that are taking a lot longer now to reach these milestones of getting married now. The percentages are going down, live with a child, and then this important one of when they own a home. So as people are getting older, less and less of them are actually able to own a home. And that's what I was alluding to in that original slide there, because it's getting so expensive and because the supply of building homes is going down. So those are three great slides here that support the investment thesis for apartments and multifamily rentals. Now we're going to go ahead and get into it, and going to have Mike here talk to us here about an exciting investment opportunity I'm involved in here with Mike. We have other investors involved here, and this is on the Hideaway Cove Apartments. And Mike, why don't you go ahead and tell us more about the Hideaway Cove? Oh, you're on mute, Mike.
Thank you. Sorry about that. Hey, before I jump in, I just want to make a couple comments on the slides that you went through. The market dynamics are definitely interesting right now. And, I've been in this business for, 30 years. And, I've seen ups, I've seen downs, I've had good times, I've had bad times. And, there's been times along the way that I have certainly made some mistakes and wish that I would have done things a different way. But here's what I know about where we're at today. If you look at the market fundamentals, you've got GDP that's up, you've got inflation at 2%, you have unemployment that is at the lowest it's been. You have things happening in politically where Trump just passed this tax bill, which is a huge incentive for anybody in the real estate space. Once we get the interest rates that come back down over the next 6 months or so here, it's going to open up a lot of doors. Some of the things that I've been seeing over the last week or so with investors is investors are getting more excited about what's happening in the market today. And one thing that I'm really sure about is that as soon as CNN and the news outlets start to say that we've shifted and we've gone into the upswing or into that first quadrant again, as you showed on that slide, it's going to be too late. Now really becomes the time to get involved in real estate and to be able to position yourself to take advantage of the next bull run. After being in the business for 30 years, I've always said, boy, if I could just get in position before this market shifts, and we're right at that doorstep today, and we'll see this market start to increase. So, Omar, why don't you switch to the next slide? So before I jump in, my attorneys, my accountants always tell me that I have to say a few things. First of all, I'm not an accountant and I'm not an attorney. So anything I share with you today is all more on the educational side and offering side. It's up to you to do your own due diligence, your due diligence of the operators of the asset, as well as the numbers that the operator puts out on the asset. Everything we share here today is confidential. You can't take this and share this with anyone else unless you have our approval on that. And what we offer you today is the same opportunity that we would offer someone tomorrow or we offered someone yesterday. So we keep it all congruent and consistent along the way. Go ahead, Omar. Today, what I'm going to cover is a little bit about the sponsor team, the investment overview, a little bit about the market that we're investing in today, some property overview, some tax strategies, and some return details. There's four things that we like to accomplish for our investors. One is that we offer preservation of capital because of the brick and mortar and you investing in that asset. Two is cash flow. Three is long-term wealth, and four is the tax planning strategies. And I always tell people that it's never too early to start planning for your taxes come the end of the year here. But I'm Mike Morawski. As I mentioned, I've been in the business 30 years. I started out at a general contracting business, went into real estate back in the early 90s when interest rates were just coming out of double digits. And, people today say, oh, interest rates are high. Well, try selling homes back when interest rates were 10% and 9% and even higher at some point. I sold residential real estate for about 12, 13 years and went into the apartment business, scaled a very large $100 million company. And during the 2008 economic crisis, had some challenges along the way and had properties that we lost everything on. However, today we have a new outlook and new insights on how we handle things. Go ahead, Omar. A little bit about the assets that we currently own and that we operate today. We're in several different markets from Florida to Texas to Oklahoma. We really monitor about 40 submarkets around the country today, and we're watching opportunities. And Omar, what's really interesting right now is that we've been underwriting assets in different markets again, and we're starting to see a big change in cap rates. We're seeing a big change in pricing and in some of those properties coming to the market. 2 months ago, we were underwriting deals and they were showing investor returns of 12 and 11%. Today, we're underwriting deals and we're higher, closer to the 15, 16% range. So what it really shows is that markets are coming back. Owners are being more realistic. There's a few distressed assets that are coming to the market, but most of those distressed assets today are being traded behind closed doors between the lender and experienced operators. So there's very limited opportunity for investors to sit on the sidelines and say, hey, I'm going to wait for a better deal to come, because a lot of those deals will not even hit the market. Go ahead, Omar. I'm going to talk a little bit about the investment. Anywhere along the way that you want to scan that QR code, that'll take you directly to the investor portal. On that investor portal, you'll see a slide deck, extensive slide deck, underwriting, executive summary, a previous webinar that was done, all the financials on the property, rent rolls, T12s, any data that you need, anything else that you would need as an investor to take advantage of this opportunity, just ask and we'll get you that data so that it will help you do your due diligence. But this property, minimum investment, and this is an offering for accredited investors only. Minimum investment into this opportunity is $50,000. We're buying an asset for $3.9 million. We're raising about $2 million in equity. Over a 5 to 6 year period, you'll see the following returns. The projected project return is about 25.8% over that 5 year period. As an investor in this asset, you're going to see a projected internal rate of return of 17% per year, which includes a 7% preferred return along the way. So this asset actually is cash flowing. We own it, we operate it. It's currently 90% occupied and it's throwing off cash. So we're able to start to pay our investors that 7% return. This has an equity multiple of 2.8. And what that means is that over that 5 year period, your money should double. So if you put in a $100,000 investment, you should see a return, including the 7% preferred plus the profit at the end when we sell the asset and exit the asset, of another $108,000. So that return multiple is 2.8. Money doubles, Omar, at a rate of 15% per year over a five-year period. And we're trying to accelerate that in these alternative assets. These alternative assets will set off a little bit better than any annuities out there, any REITs that are on the publicly traded market, and any opportunities in life insurance funds or even treasuries for that matter today. Go ahead and go to the next slide. Little bit about the property and the asset itself. When we bought this property about 6 months ago, 8 months ago now, it was partially renovated. It sits on the east side of Tulsa, Oklahoma, and I'm going to get into a little bit of market details here in a minute. But we bought it below market. We bought about 400 assets in Tulsa, Oklahoma last year, and we paid anywhere between $50,000 and $70,000 for those apartments. And this asset we actually bought at $60,000 per unit, so we have a lot of upside to drive the profitability on this property. It is a C-class asset. It was built in the mid 1960s. We're going to go in and put in about $575,000 worth of capital improvements. And most of that is going to be in the exterior. So we're going to go in and put a parking lot in, a roof on a couple of the buildings, some exterior lighting, some signage, some landscaping, curb appeal, some exterior deferred maintenance to the buildings. The past owner had already renovated about 93% of that property, interiors, and we only had a few left to do, which we have done since we've owned the property and continued to turn the tenant base and operate the property. Um, it sits in Tulsa, Oklahoma. Tulsa is rated in the top 10 for U.S. Annualized income and growth, boasting of a really diverse employment. More and more I do this, I stay involved in this business. One of the things that's really important is the amount of different diverse employers in a marketplace. When I owned properties several years ago, we were in assets that were in the Ohio Valley. And those assets in the Ohio Valley had one or two employers in those markets. And when the world went sideways, those employers in those markets got hurt really bad, which dropped occupancy and dropped revenue in those apartments. But when we looked at Tulsa, we said, okay, who are the employers in the market? And we have aerodynamics, medical, manufacturing, retail, distribution, entertainment, technology. They're building a brand new amusement park outside of Tulsa that is a $2.5 billion project that is supposed to rival Disney. There's a brand new electric car manufacturer that's building their international headquarters in Tulsa. So there's a lot of growth. The city of Tulsa has put in a lot of infrastructure growth in place. Technology is really big in this sector. Tulsa actually has a work from home program. If you're a tech worker, you can move to Tulsa. Tulsa will pay you $10,000 to be a tech worker, move there and work from home. And that has really driven population. One of the other factors is the population growth. When we went into Tulsa and looked at the population, it had grown about a half to 3/4% per year over a 5-year period. Well, in 2024, the population jumped 10%. Household income is increased as a result of that. Tulsa is the second largest city in Oklahoma. We have secured debt on this property, 10-year fixed rate debt, so we don't have to worry about interest rates jumping up on us or our mortgage payment changing. We know that for the next 10 years, we can get up every day and the same mortgage amount will need to be paid. A lot of deals are in trouble today because of floating rate debt or bridge debt. This was fixed rate agency debt that we were able to put in place. The remaining capital over and above the debt, we're raising by equity. This property we're going to be holding for a 5 to 6 year period. And as the market continues to improve and interest rates come down, we know that that's going to all be factors that are going to drive value going forward. Go ahead, Omar. A little bit about the market summary. I've kind of talked about it already. When we originally bought the property in late 2024, that population was about 993. We had reports that came out from the Census Bureau early in 2025 that showed that population today is just under 1,000,001. So it jumped 10%. The median household income is about $65,000 in the submarket. In Tulsa as a whole, the median household income is $75,000. Why does that matter to us or to you as an investor? Because I have standards for my tenants, and my tenants need to earn 3 times the amount of what the rent is. These rents will top out at about $1,100 for a 2-bedroom, and so which means that tenant or that tenant moving in will need to earn somewhere around $38,000 a year. I know that in that submarket, if the average household income is $65,000, that average tenant in the market is going to be able to handle that rent increase. The cost of living is below national averages at 7%. Unemployment has been historically the last 2 years below national averages. Again, the primary industries that we talked about and some of the emerging industries in Tulsa are the tech and IT fields, automotive technology, and some advanced aerodynamics in the area. One of the things about Tulsa also is that it is the largest repair hub for American Airlines. And in 2025, American Airlines committed $30 million to a project to hire 300 new employees to expand their facilities. So there's continued growth in these industries that we have in that market. Why is that important? Well, it's important because if aerodynamics gets hit, we still have technology, we still have entertainment, we still have distribution and retail that happens. If those sectors get hurt, there's the other sectors that will bolster. So we have people that live in our apartments that work in all those sectors. So it will help us to continue to keep occupancy up as well as keep cash flow coming in. Go ahead, Omar. Okay, again, just a little bit more about Tulsa. One of the things that jumps out to me when Omar changed to this slide is a crime report. On average, this market, this submarket of Tulsa and where our asset is we have a very low crime rate. Where the asset sits, and Omar, why don't you jump to the next slide? Where this asset sits is in a private location. It backs up to a park and a pond. It's a very private setting. All of our tenants are market rate tenants. We have no housing tenants at this property. We have no homeless issues at this property. We have no break-ins. We have not had one incident report with police at the property in 2025. And I'm very proud to say about this particular asset that when we can keep crime down, when we can keep homeless issues down, it really helps the property operate better because we're able to drive rents. You could take a look at the bottom here. And actually, this 11 buildings, it's 65 units. It sits on about 3.5 acres of land. The construction, the type was wood and frame, and you can see that the different unit mix, right? We have one bedrooms and two bedrooms. There's 45 one bedrooms, 22 bedrooms. The difference is 20 of those one bedrooms sit in quad units. The two bedrooms all sit in quad units, and then the other one bedroom sit in one of the bigger buildings. Omar, I think we can show that on the next slide. Yes, so you can see at the top left-hand corner of this slide, that's a single building, has 24 units in that building, all one bedrooms. The rest of those low buildings are buildings that have one bedrooms and two bedroom mixes in them. Each one of those buildings is a fourplex. And then at the very top in the center there, you can see, or just to the left of the center a little bit, you can see that's where the office is. So we do have a private office. Behind those buildings is that park I was talking about with the pond. And it's a very beautiful private setting off the main road. As I mentioned, we're going to go in, put a new road in from the main road, a new parking lot, a roof on a couple of the buildings, do some exterior maintenance and some curb appeal just to brighten up the property. Go ahead, Omar. Again, just a couple of pictures, a little bit of view of the property from the exterior. Go ahead, Omar. You can see some of the finishes that we've already started to do to this property. LPV full flooring throughout the interiors, walls painted, new doors, new appliances, some lighting fixtures. Now remember, these interiors, most of these were done by the previous owner. We only had a few that we needed to do when we took over ownership. We have completed those already, and we only have our exterior CapEx left to do. Go ahead, Omar. Okay, let's talk a little bit about the return details. Again, this property, the average annual projected return is a little more than 25%, which means our investors get 70% of that, which puts you at a projected 17% per year IRR, receiving 7% of that along the way in preferred equity. So, Omar, if you go to the next slide, I think I can explain how that pays out. So I'm going to use $100,000 as a basic investment just because the math is easy. But you can see year one, there were no payouts. There would be no payouts because we are building up our cash reserves. But year 2 through 4, And we're about 8 months into the first year of ownership on this. So by you coming in today, you get treated the same as everybody else. Your time frame is just a little bit shorter. So instead of being in this for 5 years, this will only be a 4 year holding for you at this point. So years 2, 3, and 4, you're going to receive a 7% per year return. That's $7,000. Year 5, we do a catch up. So you get a double return in year 5, which gives you a total just in cash flow of $35,000 over that 5 year period. The second thing at exit or at sale that happens is we return that principal amount that you've invested of $100,000, and then the projected equity piece of another $73,000. It gives you a total return of $208,000, which goes back to that equity multiple of 2.08 that I explained earlier. Go ahead, Omar. And then if you are somebody who is looking for tax benefits, this is a little bit older slide. This shows that this year, as an investor, you would have received a 50% tax benefit. What that means is your $100,000 investment, you'd have been able to write off $50,000 on your taxes. Well, that was based on the old rule of this year being 40% on the bonus depreciation. There was a tax bill that got passed, the big, beautiful bill that got passed over the last month here, which reverts bonus depreciation back to 100%, retroactive for 2025. So that's going to increase, and your write-off this year for taxes will be closer to 100% of your invested dollar amount. Our accountants have not told us exactly what that's going to look like, but they did say it's going to be closer to 100%. Now, at the end of the year, for tax reporting purposes, you're going to get a K1. That K1 is going to show you any losses or gains. You're going to take that to your accountant. Your accountant is going to do your taxes. If you're someone who qualifies to take that depreciation and the bonus depreciation, you work that out with your accountant. Go ahead, Omar. Some sources and uses. You can see that we have $2.7 million in debt on this property. We're raising the balance of equity of $2 million. We've already raised over $1 million, so we're just finishing up that raise now. As I mentioned, that QR code, if you're somebody who wants more information, want to do some due diligence, want to get involved, go ahead and scan that QR code as it comes up again. Go to the investor portal and you'll be able to see all the documents. The acquisition price on this was about $3.9 million. You can see our closing costs, our capital improvement reserves, our startup and operational capital, and then an acquisition fee, which we put on the property for packaging this, bringing it to the market. So the total all-in cost was $4,800,000 and some change. Go ahead, Omar. We'll make sure you get this slide deck sent out to you. You'll get a copy of the webinar also to go back and watch this again. But here's just some sources and uses of the money over the 5 years, how that's going to flow in, the scheduled rents, the expenses, what the NOI is projected. This is kind of our business plan, and this is what we shoot for by keeping occupancy up, by raising rents, by moving new tenants in at higher rents, by doing renewals and raising rents, and continuing to operate the property. Go ahead, Omar. Okay, so if you are someone that's interested, the subscription period is in full force right now. Funds are due now. Once you commit your funds, once you go ahead and transfer, make your contribution, you'll get a confirmation and a timeline for your investment and for the future of the investment. A couple things I want to explain about transparency. Transparency, I feel, is really important. And if you're, an investor with us, once a quarter, you're going to get an investor newsletter sent out to you. Plus, we do a video recording of everything that's happened that last 30 days. So what's the occupancy like? What's the tenant traffic like? What is the finances like? What are the repairs and maintenance? What capital improvements have we done to the property? Then once a quarter, we do an investor update. All our investors get invited to a Zoom call that we do. We talk about the last 90 days and the goals for the next 90 days. So we try to be extremely transparent. If you ever have questions, don't hesitate to reach out to myself, reach out to Omar. I have a partner, Rochelle McCoy, who is very involved alongside me with the asset management on these assets, and we're always available to our investors. Go ahead, Omar. Okay, thanks for being here today, and here is our information. If anybody has any questions and you wanted to drop those in the chat, feel free to. We'll try and get those answered here for you. Omar, I don't see any questions in the chat, and so I guess we can end here. And, just again, anybody you need anything, do not hesitate to reach out to myself or Omar. We'll be more than happy to. Uh, uh, okay, so I think Gina is asking uh, how long the opportunity is open.
Open.
That's a great question, Gina. It all depends on how quickly we raise the balance of the funds on this capital raise. That could happen in 2 weeks. It could take us 2 more months. So, as you know, if you are somebody who wants to participate, you can go into the investor portal, pull those investment documents, take a look at them. You can do a soft commitment, give an idea of timeline. We'll try and hold that position for you, provided that we can, we haven't raised the money and closed out the offering yet.
And yeah, this webinar is going to be recorded too, folks. So we'll make that available to everybody. So then that way, anything that we covered here, you can go back and review it. And obviously just reach out to, you can email me there, omar@larueinvestments.com. That's my direct email. Call me at the office there, 888-682-2290. Or reach out to my cell phone, 714-309-3823. And reach out to me, leave me a message. If I can't pick up the phone, I'll get back with you and answer all your questions.
Awesome. Thanks, Omar. Good seeing you again.
Thanks, Mike. Thanks everybody that is here with us today, and look forward to continuing the conversations with everybody. Take care, everyone.